Believe it or not, despite rising interest rates, the high cost of living, higher mortgage costs, and all the other imposts we're getting, household wealth rose for the seventh consecutive quarter. It's actually up 9.3% compared to a year ago. That's $1.4 trillion. Australians are wealthier, and a large part of that has to do with housing. We discussed that in this week's Property Insider chat with Dr. Andrew Wilson, together with his latest rental report and what falling inflation means for interest rates. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. Not long ago, the Australian Bureau of Statistics reported that headline annual inflation fell sharply to 2.7% per annum. Now, does this mean that inflation's under control and interest rates are now going to fall? Well, that's one of the questions I want to ask Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, in today's Property Insider chat. I'm also keen to get his views on the latest My Housing Market rental report, which showed some interesting, actually mixed results. Hi, Andrew.
Yeah, good day, Michael. Good to see you. And here we are in October.
Looking
forward at an accelerated rate towards the end of the year. Well, it feels like it's accelerated, doesn't it, at this time of the year?
Yes, it does. And I already, interestingly, in Church Street, Brighton, saw Christmas trees in a couple of the shop windows in October, Andrew. Yeah. But I guess it's the spring selling season. It's also that time that people are trying to finish off things in their lives, including in their homes. So people are going to be looking at buying, selling, moving, and some will be investing. Others are going to be wanting to rent. And I had a glimpse at your My Housing Market rental report, and it showed two almost varying trends. Vacancy rates are tightening, but rents are flattening, Andrew.
Yes, I think that's that affordability factor, Michael, that you sort of get to a point where you just can't keep pushing rents upwards, regardless of the tightness of availability of stock. You know, we still really haven't seen an improvement in the supply of rental properties. There's still, a lot of competition, queues for available properties, but we reach a plateau in terms of the capacity of tenants to actually pay more and more and more, particularly given the big rises that we've had over the past 2 years. So I think it's about affordability rather than availability, and but that's good news, I guess, in a sense for prospective tenants, that they're not having to continue to find extra dollars for rentals, but it still means that there's plenty of competition out there, and it's not a good market for for tenants. But the other point, on the other end of the equation, landlords have plenty to choose from in terms of prospective tenants.
Well, let's dig into the numbers a little bit. What's happening to the house markets in the rental side?
Yes, Michael, it was an interesting report which we've seen. We saw an easing in vacancy rates through winter. We commented on that. The mid-year period, we did see vacancy rates start to rise. Of course, we have started to see an overall trend this year of an improvement in the rental market, if I could call it that, from what was record low vacancy rates and skyrocketing rents. As I mentioned before, affordability is one of those factors that's started to ease rental growth. But I think that, vacancy rates have improved also marginally because prospective tenants have had to make choices. Being pushed out of the rental market or being restricted in the rental market means that they've perhaps put off their accommodation plans and also made different plans, as we've discussed here, such as share accommodation, or looking for different types of accommodation, or moving out of the capital city area. And this has meant that perhaps we've had a little bit of a better environment in terms of vacancy rates, which are nonetheless very tight. But we have seen over the last 2 months, Michael, vacancy rates starting to tighten again. I think that's a seasonal impact following those mid-year easing, which has a lot to do with lower demand. We have particularly university holidays through the middle of the year, which tends to take away some demand from the rental market. But we did see, despite vacancy rates for both units and houses tightening, Michael, overall, rents, particularly for houses, were eased again. So it's a bit of a conflict, isn't it, with tighter vacancy rates, yet an easing in rents. But as I said, I think we're looking at affordability factors that are driving that. But nonetheless, it's a good sign going forward. If we're looking for some better balance in our rental markets, we still remain very much in favour of landlords. If we look at the breakdown of the data, we saw that in terms of the monthly changes, that most capital city markets recorded falls in house rentals over September compared to August. Melbourne was the underperformer, down by 2.4%. Sydney was down 1.2%, Adelaide 1.6%, Perth 1.6%. So there's some common elements there in terms of the major capital cities with the declines in house rents over September. Volatile Darwin was the non-conformer, where rents were up by 5.6%, but that Darwin rental market can shift around from month to month. Over the past year, though, that gives us a better story of what's happened with rents. And rents in certainly the major capitals have grown significantly over the past year. Perth, which has been the top house price performer, is also the top house rent performer, up by 9.2%. Adelaide, similarly, a boom market for prices, is also strong for rents, up by 8.4%. Sydney up 6.7%. Brisbane up 6.3%. And Melbourne up 4.1%. So it still shows that there's plenty of, demand over supply pushing up rents. It's just recently we've started to see some improvement, Michael, which will be good news for tenants out there overall. Vacancy rates are still very low. We've seen vacancy rates, as I said, start to tighten again over September. And all our capital city markets have very low vacancy rates. The one reasonable exception is Canberra, where house vacancy rates are 1.8%. We're talking about houses here, of course, which is still very much a measure where we have demand over supply. But Perth, Hobart, and Darwin are under 1% again, and the Sydney, Melbourne, Brisbane, and Adelaide are just over 1%. So these are still pretty tight vacancy rates, Michael, and not really providing any hope going forward of improving our supply-demand situation in the rental market. When we look at units, a little bit different. Units were flat to higher. Unit rents were flat to higher over September. Melbourne was the exception, where unit rents were down by 1.3%. Other big performer was Hobart, up 2.3%. But Sydney, Adelaide, and Canberra rents were flat over the month. Brisbane up 0.4%. Sydney unit rents are flat now over the past year, which is an interesting result. And again, some positive news there for tenants in Sydney looking at the unit rental market. But the other markets again have recorded some positive to strong results. Perth, the leader, once again up by 11.8% over the past year. Adelaide up 11.1%, Brisbane up 5.5%, and Melbourne up, despite that fall over September, still up 5% over the past year. So, I mean, in the historical context, these are still significant rises, Michael. And as I said, we can't expect to see those what were 20% plus annual rises to continue, because we just don't have the wages growth to support those types of continued increases. So this is an adjustment through affordability going forward, which is eminently predictable. Vacancy rates a little higher, as we expect, in units compared to houses. Melbourne unit vacancy rates are interesting there at 2.6%. So the Melbourne unit rental market still has, a position where supply is, you'd suggest, above demand, and maybe reflecting those lower rents over the month. But most of the other capital city markets are below 2%. In fact, all of them, with the exception of Canberra, which is the highest vacancy rates at 3.2%. But with those couple of exceptions, Canberra and Melbourne, you'd still consider quite clearly that unit vacancy rates are tight and certainly in favour of landlords. But as we said, we've seen what I suggest was a seasonal readjustment over September and August, following the June and July easing in vacancy rates. So interesting, Michael. Still tight rental markets overall. We're not seeing the surge in rents that we have seen earlier this year and last year. I think that's the affordability factor that's just created a ceiling for rental growth. But we're still very much in a position of undersupply in our rental markets going forward. And given those circumstances, I think you'll find that eventually rents will start to rise again as incomes rise.
Well, as we mentioned a few times in this show, that we're just not building enough accommodation, so there's no end in sight for the rental crisis. Now, each month, the Australian Bureau of Statistics brings out lots of information.
Yes.
I want to, in a moment, just talk about the latest CPI figures, because that's got some interesting implications.
Yeah.
But one of the things I found interesting was that household wealth rose for the 7th consecutive quarter, up 1.5% in the June quarter. That showed that household wealth, this is taking net wealth, in other words, all our assets minus our liabilities, was up 9.3% than a year ago. And so despite many people having cost of living pressures and finding mortgages and interest rates and insurance costs more expensive, overall, because it was mainly due to the rise in house prices and also our superannuation, it has actually meant that on average, Australians still remain amongst the wealthiest in the world, Andrew.
Well, I think on a number of measures, they are the wealthiest, Michael. So we should feel good about that. Maybe it's perhaps a positive sign that we're a little pessimistic about our success. So we're not taking it all for granted. But yeah, look, that's no surprise. I think it's interesting if we look. We've mentioned the big three in terms of housing market activity, and that's Adelaide, Perth, and Brisbane. We look at those as examples. Over the past 2 years, those three markets, house prices in those three markets and unit prices have increased by nearly 40% over 2 years. So no wonder we're seeing an improvement in wealth reflecting property growth. That's a remarkable achievement, 40% over a 2-year period in, the value of properties in those, three major capital cities. And, even though Melbourne's been a slight laggard, Sydney's still up nearly 10% over that period as well. So certainly house price growth and the big three, if we could call them that, are contributing to that improvement overall in Australian wealth, which is good news, Michael.
Well, another interesting statistic for the Australia Bureau of Statistics over the last month was that inflation, or headline annual inflation, fell sharply to 2.7% over August. And that had people saying, it's under control and interest rates are going to fall. But Michelle Bullock's telling us, no, that's not the case. So what's really going on, Andrew?
Well, we sort of predicted this, Michael, didn't we? We know that we knew, and we were right, that inflation was going to fall sharply over August. It was down to 2.7%, and that's headline inflation, which takes out the volatile elements. So down to 2.7%, that's the annual growth rate of inflation. And that followed the annual result over July of 3.5%. So that's a big, big drop, Michael. And of course, although it's not the preferred measure for the Reserve Bank, it is within the target range of 2 to 3%. But also inflation, underlying inflation, which does take out the volatile elements, and it is the preferred measure of the Reserve Bank. It also fell sharply down to 3.4% from the 3.7% over July. Now that's still, outside the target range, but it's certainly moving in the right direction, Michael. But I think we're still a long way away from, as Michelle Bullock would I'm sure confirm, from really being serious about interest rate cuts, particularly given her pronouncements that they're really looking at the quarterly data, and that they would need to have a sustained period where underlying inflation was within that 2 to 3% target band. So if we're waiting for the quarterly data set, we're at least 6 months away from that occurring, I would believe, logically, before we would even be considering interest rate cuts. But let's not be too negative about that. It's certainly heading in the right direction for that conversation to commence regarding interest rate cuts. So significant contributors to the inflation rate again were housing, up by 2.6% over the year, but that was well down on that 4% rate. And maybe, Michael, that does reflect what we've been discussing, that rental increases have started to ease. Right, and as we've discussed previously, not really about more supply, but about affordability constraints. But housing 2.6% over the year compared to 4% previously, annual over July. And food was up 3.4%, down a little bit from the 3.8% annual result over the previous month. But the big mover in terms of the change in inflation was, as we have discussed quite consistently here, was fuel. Fuel was actually down 7.6%. So over the year. So the cost of fuel was actually 7.6% lower, Michael, over August compared to August last year. And that compared to a 3.4% the previous month. We've had plenty of charts, and we'll show some more today, that have shown that this was going to be a factor. But the other major factor was the government's policy that was announced in the budget of that $300 handout to households for their electricity bill. That came into effect over August, and electricity costs fell by a record, hang on to your hats, 17.9% over the year to August. Yeah, that's remarkable. We've never seen anything like that before. But that is, of course, due to the handouts from the government announced in the budgets. And it is a one-off, so enjoy it while we can. But that's been the major contributor to that 2.7% annual rise of the headline measure. But as I mentioned, the Reserve Bank target is still 2 to 3%, and we're still outside that in terms of underlying inflation. We'll have a look at, if we look at the inflation model, we can see that inflation, not just last month, but the previous month, has also tracked downwards. So we're heading in the right direction, Michael, no doubt about that, for underlying inflation. But it is all about really those fuel costs and the electricity costs over the past month. But fuel costs have been tracking downwards over the past couple of months. Our underlying inflation rate is still well ahead of the US, as we know. The US cut their interest rates by 0.5%. There's some criticism now coming through, and some quite serious questions about why that 0.5% cut was undertaken by the Fed in the US, particularly given a roaring economy, with the latest data showing a massive increase in jobs over September in the US, which is certainly put into question that sharp cut in interest rates, and also a higher underlying inflation rate in the US with the latest data. So there are now questions as to whether the Fed in the US has cut too sharply, or maybe cut too soon. But underlying inflation in Australia is still well above the US, and the US interest rate, even with that 0.5% cut, is still well ahead of our interest rate, where we're our official rate at 4.35%. They're now at 5%. But the real question mark going forward, particularly given the events of the last few days, is where will fuel end up? When we look at the relationship between fuel and the inflation rate, you can see quite clearly how they track one another. This is what we've discussed, that we knew that inflation would fall, given how sharply the fuel costs have fallen. We know that we'll also get another decline over the September inflation rate, Michael, because we know where September price of oil in September has landed, and that's well down on the previous month again. So we will see another improvement, and you can see there when we look at that, the monthly change in oil prices is down following a sharp fall over August, which translated into lower inflation. We've seen another big fall September on September, down 22.3%. So we will get another adjustment, Michael, for our inflation rate, but that may not include what's been happening in October, because over the last few days we've seen a sharp rise in the price of oil. Of course, it does reflect the issues in the Middle East at the moment, particularly around Iran and Israel. And we've seen a bit of a spike in the price of oil. Not too bad, really, considering the issues at stake. Just up around about $6 or $7 a barrel. So I think maybe that's more sentiment driven than the reality of a restriction to the price of oil. So with a bit of luck, that might work its way through the system. We obviously hope that the issues in the Middle East work themselves out sooner rather than later.
Of course.
Excuse me. But at this stage, I don't think that's too bad a result, given the initial shock to the scenarios there in terms of the supply of oil. So I think that the outlook still remains pretty reasonable in terms of the inflation rate and oil going forward. So we keep our fingers crossed there, Michael.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Each week we also speak about the auction results because they give us a good indication of how people are feeling on the ground. But it's been a funny couple of weeks with a number of disruptions, school holidays in various states, grand finals and NRL finals yesterday or on the weekend as well. So that's meant auction numbers have decreased a bit. How are the markets performing?
Well, we need a couple of weekends. It's a bit like the Easter period, Michael. Where we get disruptions over almost the whole of April. It's a little bit like that September into October. But I still think we're getting pretty reasonable results given these disruptions and distractions. Of course, New South Wales had a long weekend holiday last weekend, so that was picked up in the results, and it was the return for the Melbourne market from the AFL long weekend holiday the previous weekend. And as you mentioned, we're now starting to see states moving into school holiday mode. And of course, it's the lengthy September, October school holiday period. So plenty of distractions there for buyers and sellers. But nonetheless, I think that we still had some pretty encouraging results. As I mentioned, long weekend in Sydney, auctions well down, of course, just 461 auctions in Sydney. Clearance rate of 67.5%, which Sydney's clearance rate has just eased a little bit over the last few weekends, but still pushing up towards 70% where it's been for most of the year. So we need a couple more weekends once those markets get back to full focus to understand what's really happening in the market. But of course, auctions well down on the previous weekend. Clearance rate a little bit lower, and the clearance rate a little bit lower than the weekend before. But we had a bit of a difference when we're comparing New South Wales, because the weekend holiday was a week earlier last year in New South Wales, Michael. So we're not really comparing a long weekend holiday with a long weekend holiday. So we're not getting a lot from that, although we could compare that to last Saturday's from the Saturday of last year. And we can still see that auction numbers are well ahead now, as they've been most of the year, with plenty of confidence from sellers in the market. Melbourne bounced back after its long weekend holiday in the AFL Grand Final. Over 1,000 auctions in Melbourne. Similar clearance rate, 63.5%, whereas, much of what Melbourne's been doing this year has been in those mid-60s. Did see a couple of early signs that we've been sort of expecting, Michael, that the city higher priced properties were starting to find some buyers. Inner East and Inner South had some better results at the weekend. They're the parts of the market that have been dragging the chain and the inner city. But nonetheless, their auction numbers, again, are well ahead or ahead of where they were a year ago, continuing that trend, and clearance rates are just a little bit lower in Melbourne, lower in Melbourne compared to the same time last year. Brisbane bounced back quite strongly, higher auction numbers, more of a clearance rate we're used to in Brisbane. Brisbane had a little bit of a quiet September, Michael, in terms of its auction results, which was a bit of a surprise, although Brisbane auction results need to be taken with a grain of salt, but there's more what we expect there, above 50% in Brisbane, and auction numbers well ahead again of where they were over the same weekend last year. Same old in Adelaide. 80 auctions, well ahead of the distracted market the weekend before. Auction clearance rate similar, and auction numbers similar also to the same weekend last year, but the clearance rate a little bit lower. And Canberra's starting to look a little better now, but of course it was distracted by the grand final weekend with just a handful of auctions, the NRL grand final weekend, NRL and the long weekend, and the 21 auctions certainly well below the weekend before, but the clearance rate quite reasonable off a handful of auctions. And when we look at the trend, Sydney down. This is just the one weekend in October so far, which as we've discussed, has been a distracted period, but we'll wait and see what happens over the next few weekends at Sydney to see if that recalibrates above 70%. Melbourne, again, a one-off return from the AFL, but distracted by school holidays. Just a little lower than where it has been, but some positive early signs, and I emphasise early signs that prestige market is starting to perhaps find a little bit of life. We'll wait and see over the next few weekends. Brisbane back to where we expect it to be after a quiet September with clearance rates above 55%. Adelaide still Australia's strongest capital city auction market, approaching 80% clearance rate. And Canberra, well, what's happening in Canberra? It was a very quiet weekend. Again, a distracted weekend. We'll wait for a few more weekends to see that market, whether it can move into a revival mode, which we've been, I guess, anticipating for some time now. If you're looking for the latest auction results, and as Michael said, they're a very good forward indicator of what's happening generally in housing markets on a weekend-to-weekend basis. You can get them on my LinkedIn site, Doc Andrew Wilson at LinkedIn. Every Saturday at around about 6:30, we get the capital city clearance rates, number of auctions, and the comparisons to the previous weekend and the same weekend the year before. The full national report is published through Michael on Sundays, where you get the regional breakdowns for Melbourne and Sydney, and also the top 10 sales under the hammer for each of the capital cities.
Yeah.
That one. There's a QR code there if the screen is visible to you, where you can get that latest national report, Michael.
Well, we've only got a couple of months before the end of the year, but auction results are a good forward indicator.
Yes.
Another one is the finance figures, and as we discussed a couple of weeks ago, people are borrowing close to $1 billion worth of finance. Investors are back in the market, first homeowners to a degree as well. So it'll be interesting to see how we finish off the year, but all the indications are with confidence returning, with inflation falling, with the expectation maybe for next year of lower interest rates, our housing markets are going to continue to perform strongly over the next few months, Andrew.
Yeah, that's right, Michael. And gee whiz, we're creating all this wealth, and yet we've had to, have these higher interest rates. But as we have said here, if we put it in perspective, our interest rates are still lower than where they were 10 years ago at the previous peak, and yet we still have this very low 4% something unemployment rate, and we're still creating a lot of wealth. House prices are rising, incomes are rising, but it's and the outlook now is certainly improved for lower interest rates going forward. So things are looking pretty good towards the end of this year, aren't they, Michael?
Yes, they are. Look forward to catching up with you next week and seeing what's been happening in our housing markets, Andrew.
Thanks, Michael.